Hello there, ExxonMobil employees. Welcome. Thank you so much for joining us. I'm Sam. I will be moderating this presentation, and in just a moment, we'll be joined by Tyson Mayvar, one of our financial advisors, very knowledgeable in the ExxonMobil retirement plans, and he is here today to speak to you on whether you should decide to take the lump sum or the monthly annuity when you decide to retire from ExxonMobil. It is a very big choice, and there are a lot of factors that go into which one you should take. So he's going to break that down for you. Before Tyson comes on, though, I'd like to just very quickly remind you that we are not ExxonMobil here. We're not affiliated nor endorsed by ExxonMobil, so please keep that in mind as you're listening along today. Next, you can find links to our website. I'll be entering those into the chat throughout the presentation. Click directly on them. They're going to guide you to our website. You can book a free 15 or 30-minute block of time with Tyson or one of our other ExxonMobil focused advisors. You can follow us on YouTube, and if you have a LinkedIn, you can connect with us over on LinkedIn. We post a lot of content for ExxonMobil employees and retirees. We really feel you'd get value out of it if you considered giving us that follow. And there is a Q&A box on the screen. Feel free to ask away. It's completely anonymous. We welcome your questions. Tyson will not have time to answer them live with you, but I will make sure one of our advisors reaches out to you afterward through phone or email to answer those questions with you. And without further ado, we're going to jump right into it now with Tyson Mayvar.
Good afternoon, folks. Thank you for attending our webinar series today. My name is Tyson Mayvar. I'm a retirement specialist and financial advisor here with the Retirement Group of Wealth Enhancement Group. Today's webinar series, we're going to be talking about the ExxonMobil pension plan, some of the different distribution options that you have as an ExxonMobil employee or retiree, some of the issues with interest rates, the effects on the lump sum, and some of the important considerations that we found with our clients who we've helped retire from ExxonMobil over the last 30 years. Many of you know that we have hundreds of clients from ExxonMobil, not just in Houston, but around the globe. And our hope is that we can give you some information that you will find valuable in building a very robust retirement plan. We hope that you decide to spend some time with us, meet with us, and go through a retirement cash flow analysis. And we hope that you at least consider doing some business with us if you do choose to work with an advisory firm in retirement, but there's no obligation certainly to do that. Today we want to cover some of the biggest mistakes that we've seen people make when electing their pension, as far as the timing, the distribution options, and also some of the tax issues related to the pension decision from ExxonMobil. So as many of you know, ExxonMobil's pension plan is still a defined benefit plan, which is very unique in today's environment. Both Chevron and ConocoPhillips have moved over to a cash balance plan for their newer hires. ExxonMobil still offers a fairly lucrative defined benefit pension plan. Of course, you have to work for the company for at least 15 years and be at least 55 years of age when you leave the company to be fully vested. But you still get some vesting or some pension if you have at least 5 years with the company. And so the sweet spot is really going to be somewhere after age 55. So let's talk about some of the issues with the timing and the distribution options. Well, it's also fairly unique that ExxonMobil will allow you to take a lump sum on your pension. You could take the present value of all future projected annuity payments from the company as a lump sum, and you can choose to do with that lump sum whatever you like. You can roll it over to a retirement plan like your 401k with Voya, an individual retirement account through a number of different custodians. Our company uses both Schwab and Fidelity as custodians. That's where we manage our clients' money. There's a number of options there, and in most cases you're not going to have to pay any taxes as long as the rollover is processed correctly. Some cases where you may have a supplemental pension plan, which is a non-qualified portion of your pension. It's a portion of your pension that is taxed right after you retire. So you cannot roll that over, you cannot defer taxes on it, and if it's a sizable number, it may be a consideration for picking a different retirement date, maybe earlier in the year, so that you don't have all this taxable income in 1 year, the year you retire, and a higher tax bracket as a result, something that we would certainly want to plan for and discuss before picking your retirement date. Now, the lump sum, although popular, is not the only option. There's a variety of different annuity options. The single life annuity is going to be the biggest monthly payment. They call that the life with 5 years certain on your pension projections. What the 5-year certain means is that that is a lifetime payment for you, the employee. But they also have a 5-year period certain death benefit, which means if you pass away within the first 5 years of your retirement, whoever your beneficiaries are listed will receive the remainder of that 5 years worth of payments, whatever you did not collect because you passed away early in retirement. Now there's also these extended period certain options, the 10, 15, and 20-year period certain. Essentially, you're giving up money during your lifetime, although you do have a lifetime annuity. You're giving up a little bit of that money in order to have a death benefit for an extended period of time. And although this is not a very popular option in my experience, it may be something to consider if you have concerns over your life expectancy. I have a client that is a cancer survivor, and that was an attractive option to her because of an uncertain life expectancy. And there's a variety of other reasons you might consider that. The joint and survivor option is a fairly popular one for married couples, especially when the non-ExxonMobil party does not have his or her own pension. And certainly if the lump sum does not seem attractive for a number of different reasons, the lump sum has a great death benefit, but for a number of reasons you may consider the joint and survivor option if you are married. However, your joint annuitant does not have to be your spouse. Although that's the most common reality with this option, it does not necessarily have to be your spouse. And there's a number of ways you can take that. You can give your spouse or your joint annuitant more income during his or her lifetime, but you are going to receive less income during your lifetime, you, the ExxonMobil retiree, in order to offer that preferred death benefit to your spouse or to your joint annuitant. So a lot of great options here. We help our clients and work with our clients very proactively as they approach retirement because this is an irrevocable decision. It's a pretty big one. There's no one-size-fits-all recommendation because of how many different variables there are in people's circumstances, life expectancy and health, risk tolerance, propensity to continue working after ExxonMobil, tax bracket status, whether or not you're married. A lot of different variables will go into what's likely going to be the best outcome with an uncertain future. Now, I mentioned earlier 55 and 15, very important milestone. That is where you will be able to qualify for all of the benefits, which means a full lump sum, the ability to defer your lump sum. However, there is still some penalties if you retire prior to age 60 that you want to be aware of. And that's essentially, it's going to be 5% discount for every year prior to age 60 that you take your pension. For example, if you do leave at age 55 with at least 15 years of service, you don't have to take your pension right away. You can wait to take it, and it's going to grow by a number that's actually greater than 5% per year. It's going to max out at age 60. It's still subject to interest rate fluctuations, at least with the lump sum option. And then at that point, most people, if they're already retired past the age of 60, do not defer that decision. But there are some circumstances where it actually makes sense to wait even beyond age 60 to take your pension if you've already retired. As you can imagine, that also means that your pension isn't growing quite as quickly after you reach age 60 because you've aged out of all the penalties. It's still growing if you're continuing to work. There is a point where the lump sum starts to flatten out and actually decline at a certain age. In my experience, it's been usually in the late 60s, which means that the accrual that the company is giving you for your additional years of service is outweighed by your shrinking life expectancy. And life expectancy is a factor in the lump sum calculation, as well as interest rates, which we will go into in just a moment here. So single life annuity, highest payout. This is the default payment option for a single individual. It's what the formula equates to on the ExxonMobil pension without having to do any conversions to add a joint survivor or to convert the future annuities into a present value lump sum. And once you pass away, the payments stop. But it is the highest payout and a fairly attractive option for folks that aren't interested in taking the lump sum and normally, in my experience, who aren't married. because it's going to be the most guaranteed lifetime income possible from the ExxonMobil pension plan, short of taking the lump sum and creating your own annuity. So fairly popular over time. Does not have a cost of living increase, meaning that you'll be getting the same monthly check 30 years after you retire if you're still alive, meaning that money's not going to buy you quite as much in most cases as it did at the beginning of retirement, if we assume that there is inflation or depreciation of our dollars over time. And certainly a concern that I hear from a lot of people that I work with, one of the reasons, even though interest rates have climbed in the last few years and the lump sum payouts are smaller than they were 5 years ago, for example, in my experience, just as many people now are taking the lump sum as 5 years ago when lump sum payouts were higher. The biggest reason I've heard from people, of course, there's the death benefit flexibility of the lump sum, ability to invest that however you want. Now fixed income investments are paying more interest than they were 5 years ago. There's a lot of reasons people are interested in the lump sum, but the biggest change in perspective that I've seen is concerns over future inflation. If our government continues to inflate our way out of our debt, increasing the money supply, and cost of living increases are high throughout your retirement, this is a risk for taking any of these annuity options because there is no cost of living increase. And a reason that, in my experience, a lot of people are still taking the lump sum because of concerns over inflation in the future throughout their retirement. Now, the joint survivor annuity, similarly, is a lifetime payment for you, but it's also a lifetime payment for one other individual, normally a spouse, but doesn't have to be. And as a result of being good for 2 lifetimes, of course, the life expectancy of 2 people is always longer than the life expectancy of 1 person, which means that they don't have to give you as much money during your lifetime because you have additional death benefits associated with a joint survivor annuity being paid to somebody. So there's a variety of ways that you could take this. You can take a 100% joint survivor, for example, where your spouse or your joint annuitant receives the same income as you did during your lifetime after you pass away. But that is going to see the biggest discounts during your lifetime in the early years of retirement as a result of that better death benefit. Fairly common one is the qualified joint survivor, or also the 50% joint survivor, where your spouse or joint annuitant receives half of what you got as the retiree during your lifetime, but you get more money in your lifetime together. There's a lot of ways you could slice this. It's in part going to be a function of your spouse or your joint annuitant's resources, whether or not they have their own pension, what are the resources you have, how well you saved in your 401k, if you plan to work is a big factor as well, if you plan to work after ExxonMobil. Because you're likely, unless you're under age 60, it's probably not going to make sense to defer the election of your pension. And if now you have this unnecessary income that is taxable on top of your income from your work after ExxonMobil, you're paying unnecessary taxes, whereas the lump sum will allow you to be a little bit more tax efficient, potentially, with growing that money and paying the taxes on that money at the time that makes the most sense. But a very popular option still for many folks that are not interested in taking a lump sum and what goes with that, and who are also married or concerned with longevity risk of 2 individuals rather than 1 individual. So lump sum, still in my experience, the most popular option. That could be based on a biased data set, though, because usually people are calling us for help with their retirement planning, more so when they need help with the pension. I think there's some people out there that they take the annuity, they may need our help or need the help of an advisor less than somebody who takes the lump sum. Something else to consider that a lot of people don't is when you take a lump sum, you're responsible for now creating an income stream with that money. So you may need to be more conservative than somebody who takes the annuity and has that fixed income source. Because your withdrawals from your retirement account, which we will assume is invested, are going to be larger if you take the lump sum than your withdrawals from your retirement account if you have that fixed income from the annuity, and then eventually Social Security as well. So how you take your pension may change how your portfolio is set up to produce the income you need to be tax efficient. There's a lot of variables that are affected by this one decision. So this is what we focus on most in the beginning. And once we start to have more confidence in what is likely going to be the best option for our client and their family, then we can back into some of the other decisions like retirement date, how to invest the money, where to pull from, which accounts to pull from to be tax efficient, whether or not you need to work after you leave ExxonMobil, and how much you might want to target as an income if you do some consulting or contracting work or a part-time job, for example. And then also how and when to take Social Security is in part going to be a function of how you take this pension. So lump sum still fairly attractive to a lot of people, but it is going to create some decisions that you have to make after you leave ExxonMobil, in particular how to invest this money and who to have help you if you decide to work with an advisory firm. Now, I get a lot of questions from folks, why, when interest rates go up, does my lump sum go down? And the best analogy we've been able to come up with on this is likening this to mortgage payment. So let's say, for example, your budget for a home is $4,775 per month. That's how much you can afford if you're going to buy a home. Maybe you're a first-time home buyer, or maybe you're buying a retirement home. And let's say at that time interest rates are 4%, and we're looking at the interest rate for a 30-year fixed mortgage, for example. Well, you may go to the bank, and the bank says, we will lend you money to allow you to afford a $1 million home based on your $4,775 a month budget. So let's say you come back a couple months later. Now interest rates have gone up from 4% to 5% on the same 30-year mortgage. Here I'm thinking about that. We missed those days not too long ago. They were under 3%, and now they're north of 6%, in some cases 7%. Well, let's say interest rates went up 1%. And you still have the same budget. You can afford the same monthly amount to go toward a mortgage. Same 30-year fixed mortgage. Now you can only afford an $889,000 home, whereas just a couple months ago you could have afforded a $1 million home. So interest rates went up. The lump sum of money the bank is going to lend you went down. Same thing with your pension. It has to do with present value calculations and the time value of money. And another way to think of this is, given a fixed life expectancy, if interest rates were higher, you could earn more money on your lump sum. So in order to make you indifferent between taking the lump sum and the annuity on your pension, the company doesn't have to give you as much money on your lump sum in a higher interest rate environment to make that money last just as long as the annuity. Now, something else that's really important to understand is how the company observes interest rates, and it depends whether or not you are grandfathered. Not many folks are grandfathered anymore because to be grandfathered you essentially had to be retirement eligible, 55 and 15 years of service, by 2012. So here we are 13 years later. Most of these people that are grandfathered, they're at least 68 years old. So there's still a few guys and gals out there that are grandfathered now, and the significance of that means you're using the 30-year treasury to calculate your lump sum, which is a more favorable rate because it's a lower interest rate, and that rate changes quarterly. They use the interest rates from 2 quarters ago to calculate what your lump sum is this quarter, and they change quarterly. They take the average of the 30-year treasury and round to the nearest quarter percentage point on the 30-year treasury. This is again for the grandfathered folks. Also, if you're grandfathered, you have more flexibility on choosing your retirement date. You don't necessarily have to take the first day of the month after you retire, for example. So it is more ideal if you're grandfathered, but most of you are not grandfathered. And if you came over from a company like, for example, XTO, or certainly Mobil as well, you're going to have, you're not going to be grandfathered. You're going to have these corporate bond interest rates being used to calculate your lump sum. Well, what interest rates do they use? If you're not grandfathered, they don't use the 2 quarters prior as a look back period. They actually use the 4th and 5th month prior to the quarter in which you retire and the interest rates from those 2 months. For example, if you take your pension, it's not about the date you retire, but the date you commence your pension, your benefit commencement date. is how they figure your interest rates and, of course, your lump sum. If you retire, let's say today, here we are in October of 2025, but you wait to take your pension, let's say until the first quarter of 2026, let's say January 1st. Could be January 1st, February 1st, March 1st. Those are the 3 commencement dates for a non-grandfathered employee. Well, they're not going to use first quarter 2026 corporate bond interest rates. They're actually going to look back to September and August of the prior year, 2025 in this case, which are the 4th and 5th month prior to the first quarter. They're going to take an average of those corporate bond interest rates, and that's what they're going to use to calculate your lump sum. Well, to know the August and September interest rates, we usually don't know that until about October 20th through 25th, sometime late in October. And that is when the company will update the pension modeler and the EDA website, and that is when we can evaluate whether or not we should take our pension, in this example, in the 4th quarter or the 1st quarter of next year, or continue waiting into subsequent quarters for a chance at even lower interest rates. Something we encourage a lot of people to do as they, especially if they retire prior to age 60 and are able to age out of the penalties, and especially if we're in a higher interest rate environment as we are right now, at least relative to the last 15 years, that may be an argument for waiting beyond your retirement date to take your pension if you have the ability to. Something else to keep in mind, you cannot elect your pension beyond age 65. If you retire the year you turn 65, they'll give you a full year to defer the election of your pension, but the normal retirement age is 65, so you have less flexibility in choosing your commencement date and maximizing your lump sum for folks that do retire after the age of 65. All right, I'm going to zoom into this table here. What we're looking at is the most recent 2 months of corporate bond interest rate data on top here. That's August to July 2025. July's interest rates are not relevant whatsoever in any pension calculation, but we just showed that to see the trend here. You could see we know the Q4 2025 interest rates, folks that commence their benefit in the 4th quarter of 2025, which, as it turns out, we're using May and June data, May and June corporate bond interest rates. They took an average of those, and you can see July was lower than the average of May and June. And August is also lower on all 3 segment rates. So the trend is now that the interest rates are starting to come back down. And while recently the Federal Reserve did reduce interest rates by 1/4 point, remember that the short-term interest rates that the Federal Reserve controls is not perfectly correlated with the interest rates that affect your pension. Your pension is affected by corporate bond interest rates, which don't always correlate to short-term federal funds rates. Sometimes the federal funds rate might be declining and corporate bond interest rates are increasing, indicating normally a flight to quality where people are selling risky assets and buying safe assets. And it could be the opposite. It's true. It could have corporate bond interest rates decreasing while the Federal Reserve is hiking rates. So these rates have certainly come up since last year. They've come up quite a bit since 2021 when we saw some of the lowest interest rates in the history of ExxonMobil retirees taking pensions. And when a lot of people left, many of you probably remember a lot of your coworkers leaving, it's possible we could see a return to those interest rates, but in my opinion, it's not likely. And there's a lot of issues that we need to talk about when we're picking not only the optimal retirement date, but the optimal pension commencement date. Interest rates are a big part of the decision-making process, but just know that most of you do not have to take your pension right away, and there could be some good arguments to wait to take your pension, both to get more money from the company, and also there could be some positive tax implications of waiting on your pension. Also, what I've seen, unfortunately, a lot of people don't spend a lot of time evaluating advisory firms throughout their career. I encourage people to do a test run of our services and maybe a couple different companies before they retire to see who they had the best fit with and with a smaller amount of money. If you are able to do that, it's a great way to test the waters, so to speak, on the advisory firms, the services they offer, the performance on the investments, customer service, all of that stuff that's important to most people. Fortunately, almost nobody does that much due diligence ahead of time. A lot of people wait until the year they retire and just start talking to 5, 6, 7 different companies and make a gut decision on who to go with, which unfortunately isn't always the best way to do it. If that's you, if you didn't put a lot of work into it ahead of time, that may be another reason to defer the decision-making process so you have more time to really talk to several different groups, see who has a good track record working with ExxonMobil clients, see who you have the best relationship with, who your communication is good with, who gives you the best advice along the way, who you trust. That's a big part of it. And then if you have the ability to allow a company to manage some of your money before retirement, how did they perform on the investment? Something that's also pretty important for, at least should be, all of us. Now, in review, we have these 3 primary annuity options that you have. With the lump sum, you may not want to take this all right after you retire. In fact, even with the annuities, there might be an argument to wait on taking your annuity, especially if you're not 60 before you leave, and certainly if you're considering working and making some taxable income after you leave ExxonMobil, could be another argument to defer the election of your pension. There are options to take a hybrid where you take part of your pension as a lump sum, part as an annuity. And for those that just can't make a decision, I've seen that be a pretty good way to hedge your bets. Uncertain life expectancy, not wanting to make the decisions, your risk tolerance is a factor there. You could split it up and take half of your pension as a lump sum, half an annuity. Great option. Or what some other people do too is, rather than making a decision on the day they retire or near the day they retire about whether or not they want lifetime income, a lot of people will take the lump sum and defer the decision. Maybe wait for a higher interest rate environment, or maybe if one of you passes away early in retirement, your spouse or you, you're likely able to get a better payout for the surviving spouse if you defer the decision on lifetime income. So you don't necessarily have to make that decision at retirement. Of course, the way you do that is through an insurance company that have costs and different benefits that you need to intimately understand before entering into one of those agreements, because while it may not be a lifetime commitment, it's going to be a long-term commitment, and those warrant some serious due diligence before entering into those types of contracts. So we're here to help folks. We found statistically that 74% of Americans over the age of 50 don't have a written plan for their retirement. This is a staggering statistic. This blows me away every time, just because of how important I know this is. And especially because a number of companies, including ours, are happy to run your numbers, provide an analysis, and give you a consultation on a complimentary basis. We do this because we know there's a good chance you might work with us in retirement if you give us an opportunity to introduce ourselves and talk to you about our value proposition. We also know that even if you don't go with us, there's a good chance you might refer us to some of your coworkers, and that's really how we've grown our business the last 30 years, is by relying on kind words from the people that we work with, whether or not they become clients, to their coworkers, so that we can help as many people as possible. And what goes around comes around. So no obligation to do business with us if you take us up on this retirement cash flow analysis, or if there's another type of analysis, an estate plan review, a net unrealized appreciation analysis for those of you that have ExxonMobil stock, a Roth conversion analysis, a Social Security analysis. All of these are important at different segments of retirement. We're happy to do all of these things on a complimentary basis if you're willing to spend some time with us. So let us know how we can help. And if you'd like to come to one of our live events, we do them regularly in Houston and really throughout the country, but the ExxonMobil specific talks are primarily in Houston. And a variety of different content on LinkedIn and on YouTube, some specific to the ExxonMobil benefits and some just generic retirement, investment, and estate planning that we think are valuable. To get a hold of us, you can email us at info@theretirementgroup.com. Call us at 800-900-5867, or take a picture of one of these QR codes. On the left here, we have the meeting to get on mine or one of my colleagues who understands the ExxonMobil retirement strategies intimately. Get onto our calendar, or to go follow us on LinkedIn, where we publish a lot of this content. You can keep up with some of the changes happening at ExxonMobil. With that, we will wrap it up. Thank you all so much for your time today. Everybody have a great and safe rest of your week here. We hope to talk to you all very soon.